Welcome to Fintech Fridays.
Oh yeah!
A weekly podcast brought to you by the National Crowdfunding and Fintech Association of Canada and partners. Covering all things fintech, blockchain, P2P, AI, and alternative finance.
Good afternoon, everyone. My name is Craig Asano, the founder and CEO of NCFA Canada, welcoming you to Season 4 of Fintech Fridays. Today is episode 61, a weekly podcast brought to you by NCFA and partners, where we sit down with the incredible fintech and funding community, talk all about new launches, trends, product innovations, developments, and challenges as well. So today we have a fantastic guest with us. We have Mr. Kay Khemani, who's based in London, England. Mr. Khemani is a seasoned professional in the finance and investment sector. He's currently the Managing Director of Hatchworks, a venture firm with an in-house incubator who vets and invests across a wide range of sectors from gaming to fintech, renewables, AI, health tech, and crypto. Kay is also the Managing Director of a company called New Chattel, who's involved with the investment committee at Hatchworks, and he's the co-founder, advisor, and speaking rep for the Phoenix app, which is what this podcast is going to focus on today. The Phoenix app, I'll just say a couple words. It's a cutting-edge platform designed to transform the way individuals engage in passive investing. The Phoenix app enables users to become market makers in global trading of top cryptocurrencies, offering investors the opportunity to earn real-time yields in USDC. Prior to these engagements, Kay was the executive director at Goldman Sachs. He had a 2-year post there from 2009 to 2011. In his role, he was responsible for researching and investing approximately 100 pan-European cross-sector listed companies. His focus was on valuation, stock picking, and generally contributing to the internal investment fund at Goldman. Kay is an advisor and an active product expert with a variety of portfolio companies. So combined really with his entrepreneurial spirit and his advisory roles, he's a distinguished figure in the financial investment landscape. So Kay, thanks so much for joining us today to share your knowledge and experience.
Thank you. It's a pleasure, and thank you for having me.
Yeah, welcome to the show. So episode 61, cannot believe we've already reached this milestone. We're really excited to get into the discussion to talk all about the Phoenix app and what you've been up to and hear the latest and greatest. So to kick things off, let's just talk a little bit about your professional background, sort of your journey, what you've been doing and your road to getting involved with launching and involved with the Phoenix app.
Sure. Thank you, Craig. So basically, as you rightly said, before I was doing all of this, when we've been doing this for almost 12 years now, I was working in high finance. I did a few years at Goldman Sachs, traditionally in equities, working in equity research. And then before that, I was actually at JP Morgan for 4 years, learning the ropes of research as well, investment research, studied a lot of sectors. And then I got into entrepreneurship around 2012, and it was a very exciting time. You know, the whole advent of Web 2.0, it was in its swing, and we got heavily into it. We created a few financial technologies over the years. We had our fair share of failures as well, and small successes, but more failures. And then we started to become a bit more seasoned as entrepreneurs. Rather than pure corporate people, we understood what it takes to actually bring a business to profitability, which is very difficult, as you probably know, and to sustain it as well. What happened around 2015, 2016 is, as blockchain technology emerged kind of out of the crevices, slightly more into the mainstream, Ethereum allowed smart contracts basically to be used in a range of applications in blockchain. It wasn't just about hodling Bitcoin and hoping for the best. It was actually about how you can use smart contracts and get rid of bad actors. For example, it is now possible for you as a trader to trade directly and buy Ethereum and Bitcoin and a range of digital currencies against a non-entity, a smart contract, basically. Historically, if you were to buy any asset, a stock or a bond or anything, you would have to go through your broker. Now, Robinhood and all of these brokerages, they've allowed you to make this process pretty seamless. When you log into your terminal, you are effectively trading, but basically the other side of the trade is either another trader, but the intermediary is always a broker. So with smart contracts, you can get rid of this, and that also means you could get rid of broker fraud. And that was our mission basically in 2016, 2017, is to use smart contracts to allow traders around the world to trade financial assets against other traders, but using an autonomous entity as a middleman rather than a broker. And the reason behind this is brokers would steal your deposits. This was a big problem in binary options, also in foreign exchange trading. And this allowed us to kind of crack that code, if you will. Now, what happened, of course, is you may know this, or some of your viewers may know this, is that CFD, contract for differences trading, typically 85%, the figure can be a bit higher depending on which country you're in, 85% of traders lose money over time. It can be even as much as 95, 97% if you go to retail. Institutional, approximately 70% of institutions on CFDs don't make money. So it's pretty bad. So although we were able to address the problem of removing the broker from the equation, allowing traders to trade without any intervention, the main problem of traders not being able to make money, that remained unaddressed. That's where Phoenix came into the mix. So what has happened is it's possible now for you to actually to take the other side of the trade, to actually become the market maker using smart contracts. The company that started all of this, it's actually New York based, it's US based, it's called Uniswap. They are the world's largest decentralized exchange. Billions of liquidity is flowing through there every day. But the beauty is they've democratized this, and they allow you to actually become a liquidity provider so that traders around the world can buy Bitcoin and Ethereum and USDC directly from you. But you don't know they're buying it from you. You're literally interacting with a smart contract. The process is complex. What I've described to you, I've summarized it, but for you to actually do this, to get to grips with what it means to actually contributing liquidity, setting ranges, deciding if it's going to be asymmetric or non-symmetric, all of these things, that's what Phoenix takes care of. So for the retail investor, we're basically simplifying the whole process. What does that mean, basically? The retail investor does not have to work anymore to speculate, to do market research, to do fundamental analysis, technical analysis, learn about companies, learn about the underlying currencies if they're trading currencies or bonds. It's a good thing to know. For example, we do have that knowledge on board given our backgrounds, but it's not something we expect investors to know who just want to make money on the side as a passive income. And so this is, as we were discussing before the podcast started, you mentioned, how are the users doing? The good news is we launched this last year in April or May, after 2 years of research and development, of course. And all the users that have joined, they've made money. They are market makers. They are not buying, for example, Tesla shares, or they're not buying the euro versus the US dollar with the view to sell it later at a higher gain. That onus to get that research and get it right is not on them anymore. All they do is they provide liquidity for other traders to buy and sell. And for doing that, for providing that liquidity, they basically get a small fee. And from that fee, Phoenix takes a cut, the rest goes to them effectively. So basically we're democratizing through smart contracts the ability for users to make passive income by becoming market makers. And that technology hasn't existed so far. Now, obviously, we'll get into a bit more in detail, but it's not like one is earning sort of treasury yield type of returns, 2, 3, 4%. If it was that, we wouldn't be doing it. It wouldn't be exciting, right? Although it is a new revenue source of investors to make money passively. What makes this exciting is the rate of return you can earn adjusted for risk. So if you look at this from a risk-adjusted return standpoint, that's where Phoenix really stands out relative to other ways of making money in blockchain, but also TradFi, traditional finance. We can talk a little bit more about the returns later and the risk if you would like, but I can also go over them now.
That's totally up to you. I was just looking at the outline. I think we've got the next 45 minutes is all dedicated right to this conversation and the Phoenix app. Yeah, maybe it's a good time. Let's talk a little bit about the risk and the reward and how it compares for the benefit of let's say retail investor that may not have had that much exposure to crypto investing, and maybe, as you sort of alluded to earlier, that they're used to more trading. They might not even want to be involved with self-custody. They might be trading on an exchange. So how do the yields compare? And the word complexity, let's try to simplify it for anyone that might want to learn, what it's about and what it really will mean to them in their own portfolio.
Okay, good question. So firstly, in terms of the returns, we have three classes of pools. Basically, when you join the Phoenix app, which of course is free, I mean, you don't get charged for sign up, you just sign up, and we ask you to read all the information in the app, but of course, our team can also advise you. Now, you have three pools. One is for the very low risk investors. For the category you just mentioned, the people that are completely new to the blockchain, for example, and let's say they have $100 to invest, right? Because that's the minimum amount that one can get in with. And basically at that point, we would say, okay, you should go for the lowest risk option. That pool is called buffer, and that's called buffer because it's there to buffer the movements in the prices of the currencies that you provide liquidity in. So if you're providing liquidity as a market maker in Phoenix, you're not doing anything. It's all Phoenix is taking care of that for you. But what we're basically doing is that the bulk of your capital, the $100 that you put on the liquidity curve by using Phoenix, almost 80% of that is in US dollars. So the bulk of that is in a fixed stable currency. And then 10%, for example, would be in Bitcoin and the rest would be in Ethereum. That's just an example. What that means for you as a liquidity provider is that because the bulk of your allocation is in a stable coin, a US dollar, if you will, the fluctuation, the value of your inventory as a liquidity provider is going to be very minimal if 80% of your capital is not in those coins. You'll still make money because you'll be selling Bitcoin and Ethereum to people that want to buy it from you. So you get a small cut, but you'll also be selling some of your dollars for people that want to buy dollars from you. And in the blockchain world, dollars are represented by very regulated stable coins known as USDC. You may have heard of them. They're planning an IPO soon as well. They're based in the US as well, regulated billion-dollar project. So what makes this exciting is this low-risk pool, you'll only earn around 7 to 10, right now it's doing around 11%, 7 to 11% a year in yields. Now, when I say a year, that's the annual percentage yield. That's not compounded. You can, of course, compound that at the frequency you like, but that's approximately the yield you'll earn. And that tends to beat, it's approximately in line with what stock markets will earn you over time, that kind of traditional 8 to 10% a year over time. And it's well ahead of real estate and certain other traditional investments. And it also beats inflation now as well, considering inflation has come down. That's 7 to 11%, but it's not that exciting. But of course, it's also very low risk. What I mean by this, just to give you an example, is if Bitcoin, for example, fell by 20%, which can happen, the value of your portfolio will drop by approximately 2%. So that's a kind of acceptable risk, I would say, for someone who is new. Now, if you want to move up the risk curve, so let's say you spent 6 months in Phoenix, you had $100 invested in the system, and you said, okay, I like what I see, I want to expand my position a little bit, then you can upgrade or you can move your position to the cruise or the ignite pools, which are medium and high risk respectively. And all that means is that we've changed the allocation of how we're parking your capital on the liquidity curve. So instead of 80% in USD, it'll just be 50% or 40%, and the rest will be in the other top decentralized currencies. You, as a result, will earn more as a liquidity provider. And the fees there range for the medium risk. They're approximately 12% to, I would say, 15, 16% for the medium pool. And for the high risk pool, it's approximately 20 to 30%. So that's, you're really beating the markets there. And this is, of course, a real time. So that's two really important points I'd like to make is regardless of which pool you go inside, your capital is never tied up. That's something we really want to stress is you're not investing in a hedge fund. You're not investing in a project that will yield, let's say, over 5 years, you'll get your capital back and you're tied in, you have lockups. No, your capital is literally parked on the decentralized liquidity curve. And anytime you want to withdraw it, you just click the withdraw button, it gets withdrawn, it's sent back to your address. That's the most important thing. The same thing is with your fees. Your fees collect in real time. Every second or approximately every 5-10 seconds, someone is buying or selling a digital asset on major exchanges like Uniswap. You're just getting a part of that action. And when that happens, you see your fee increase in your app. So it's all very transparent. It's all backed with on-chain data. And that's basically the risk, if you will, in the system. There are no existential risks, so to put it. For example, if you are trading with I won't say a bucket shop, but let's say you're trading at a broker and that broker goes under for whatever reason. We saw that with some bankruptcies historically as well. You're only protected by the amount that by law is insured. So typically that's $75,000 in the US. It can be up to 100K in Europe, similar amounts if the broker is regulated. Here, there is no broker, but your money is lying on a decentralized smart contract that has had literally close to $30-40 billion flow through it in the last 2 or 3 years, heavily audited, never hacked, and one of the top industry teams behind it, the Uniswap team. So it's very, very, very industrial strength when it comes to security in that respect. So there are risks, but they're limited, broadly speaking, to price action, basically, and which pool you get into, if that makes sense.
Yeah, absolutely. I mean, as an investor, you want to understand where your money's going, and you want to understand what those risks are. And I'm going to be the devil's advocate here.
Sure.
and try to, be a retail investor that has some questions. I mean, one of the obvious questions would be is cases like Luna, or in the news, we've had a lot of unusual risks for investors depending on their appetite, market crashes, and this extreme volatility, and how the ecosystem has managed to rally back has been quite remarkable. But there's a lot of lessons there.
Yeah.
I mean, maybe you can talk about your perspective and how that might impact, or what are your thoughts with the Luna crash and the fallout, and what its impact might have been to investors then, and what's happening today, and maybe let's take it a little. What do you envision how that's going to play out?
Fantastic question. So Luna basically changed the game for the worse. Luna happened in first approximately, if I remember from memory, early 2022, maybe a few months before that. But Do Kwon, who was the founder, who's currently a fugitive, and he's going to be tried by the SEC soon. You had a bunch of, and you had a bunch of kids from higher education places who raised a lot of capital in the previous bull run. This guy was one of them, and he was a fast talker, and he created an algorithmic stable coin. An algorithmic stable coin, all that is you may have heard of USDC, you may have heard of USDT. They are the two biggest stablecoin, multi-billion projects. And if people want to move out of Bitcoin, out of Ethereum into stable currencies, they basically sell the former and they get into the latter. It's been a mainstay of crypto for a long time. And right now, the market leader is USDC. This kid, basically, he created the Terra organization, and Terra had a bit of a run. He raised money, and they basically created this narrative that algorithmic stable coins is the way forward. You don't need to have a fiat currency. For example, fiat currency used to be backed by gold until it was depegged. They basically said that stable coins in crypto do not need to be backed by anything but a very smart algorithm, basically. So no treasury. And that was the first red flag. But because they showed fancy maths papers and people got a bit excited, and it was the bubble, right? We were in the middle of the 2021, the second bull run. Pandemic had happened, a lot of helicopter money going around. People were really excited. They said, you know what? This stable coin is offering us 20% a year yield. 20% I'm earning in cash. And I can withdraw at any time, and there's no risk to my capital. So in Phoenix, for example, I told you in the highest risk pool, 20 to 30% a year is what you can earn, but there is risk to your capital. The inventory value will fluctuate. What Terra said was there's no risk to the capital. And this peg will always remain because our algorithms are smart. And if there's ever a slight depegging to the dollar, it will go back up. Now, fact of the matter is, on that narrative, they raised $1 billion plus or something. A lot of investors from Asia as well went in there. They raised $1 billion plus, I think it was even $2 billion. And they had all this liquidity to throw at the coin if there ever was a depegging incident. Lo and behold, that depegging incident happened. And although they could defend that for a certain bit, once you get a depeg, when you get a stable coin, it depegs to the dollar, a lot of fear percolates in the market. And they weren't able to manage that. And then people started dumping too much. And then the Ponzi just completely exploded. Now, here's the thing. In answer to your question, what was the problem with Terra? The red flags were there for the reasons I mentioned, but the biggest problem was there was no real source of revenue. How were they generated? They told you, Craig, come and put your capital with us, buy this Luna coin, the stable coin, and you will get 20% a year, and you get paid in a stable coin. That sounds great to you, especially if you can withdraw your capital, but you have to ask yourself is, how are they making that 20%? It turns out that 20%, your money was being parked in other circular DeFi, decentralized finance. There was a lot of DeFi schemes at that point offering 100% return, 150% return by whiz kids, quote unquote whiz kids, who are all now in jail or disappeared. And so your money was basically being recycled in other Ponzi's. And it was horrible. It was really horrible because it worked for a bit. So people got excited. They overgeared. At one point, our firm had put in almost 70, 80K into it. We lost 30K on the Terra collapse. We pulled out the moment the DeFi happened. Other people lost their life savings because they thought they would, the algorithm would save them. The problem is there was never a clearly defined source of revenue. Here, and by the way, that's not just Terra Luna. This is almost all staking programs in crypto. The source of revenue isn't there. It just isn't there. It's just hopium. More money coming in to buy the project, so the project can use some of that treasury to pay you. It's robbing Paul to pay Peter. And this still continues. And projects like this will lure in investors and say, oh, you're earning this much in traditional finance, 5 to 10%. We can earn you 60, 70% a year or 100%. So you put your capital there. We're like moth to a fire, to a light. We get excited by these returns, but they never last. With Phoenix, it's a completely different story because we've told you the source of revenue. There are billions of buying and selling happening every day on Uniswap, on some of the leading decentralized exchanges and centralized exchanges. In a centralized exchange like Kraken or Gemini or Coinbase, you can't become a market maker readily, but you can in the decentralized markets. And that's what Phoenix does. And you can see how your revenues are generated trade by trade. So it's a completely different ballgame. But in answer to your final question on that, what it did to investors, it made investors much more distrusting, which I think is good in a way because they're much more protective of their capital. Like you saw the ETFs being approved, the Bitcoin hasn't gone up that much, and it's actually gone down. And that was much to the chagrin of many people and also surprise. And I think that's good because I think now you will start to see more stable programs coming through. And by the way, it wasn't just Terra Luna, it was also Celsius. They were offering you 5, 6, 7, 8% on your money. You put down $10,000 or $50,000, you get a bit more. They were investing in stuff like Terra. They were investing in other stuff. So it was all circular. There was no real source of revenue or no tangible source of revenue.
So as an investor, what advice would you provide retail investors or anyone who's dabbling in crypto and some of these yield farming staking programs? How do they identify a red flag? What are the top red flags to look out for? And on top of that, if we can dig in a little bit in terms of the Phoenix app and how they're mitigating some of the overall risk and the overall risk portfolio, I think that would go a long way to, building that confidence and understanding. It's really about education.
Absolutely. So some of the main pitfalls, the way you can spot a scam pretty quickly is firstly just go to the team section. I know this sounds so bare bones, but it actually is one of the best way to weed out a scam or a potential disaster. It doesn't necessarily have to be a scam in the traditional sense. The founders can be well-meaning, but the question is, where is the culpability, right? Where are they appearing with Craig on camera, showing their faces, their location, their CV on LinkedIn and stuff? You won't find this in 90% of DeFi projects today. Yeah, they may offer you 50, 100% yields, but you don't see the team. You don't see the team because most of the teams are breaking securities laws by offering these type of things without accreditation. They're not doing accreditation checks. They're not doing KYC. They're doing nothing, right? And most of them are in America or China. It's one of the two. And so they're basically on the run because they know eventually when the party stops, they're sitting with a treasury, they're going to rug and take that money, or they're just going to abandon the project, which ultimately for you, the investor, results in a total loss of project value. So that's the first sign. Please make sure that if you are getting very excited by a project and you see that they don't have a team, or you have guys called Big Flipper, if that's the name of the founder, or iPhone Red is the name of the co-founder, then only invest 1% of your capital. Enjoy, hope that does 100x, but never ever bet your house on it or anything like that. The second thing, of course, is it should be a very easy question to be answered, but you'll be surprised that once you enter DeFi, how complex it becomes. Like I've explained to you basically how Phoenix makes money for you today. And I understand that some of the terms were probably new, but if your users rewatch this, it'll make sense. There's market makers that make a market for traders. Market makers make a lot of the money. Traders generally lose money. If you become the market maker, you have way less risk and you make money. That's what Phoenix does for you. So along with those two checks, basically, first to find out who the team is, the second of all, to find out what the source of revenue is. Once you've done that, you're already dealing with a good project, right? If you have the answers you need, then it's all about capital allocation. And that's just common sense advice that you can avoid most pitfalls by doing that. The final one that I would alert investors about is the level of returns that the project is promising. So typically, if you go to Phoenix, the website today, you will see mention of the type of returns in terms of qualitative statements like double digit and all that. But you will never see crazy statements like make 50% a week or 20% a month or 100% a year or anything which sounds too good to be true. It's very easy, especially in today's cost of living crisis. We live in a very difficult period, especially for the younger generation. So you have a bit of money, you're like, okay, let me bet the house on it. Maybe this is my one shot thing. It's not your money. You're going to lose money. You're 99% of the time you're going to lose money. So make sure that the returns make sense to you. So when you're entering the blockchain space, you are taking on the risk of leaving traditional finance and the protections that that part of the financial sector affords you. When you move into blockchain, it's a bit of a black box. And so these sort of checks that I've told you today, if you do those, you'll fare well. And just note that when you're entering this higher risk space, you should demand higher returns. If there's some project in the blockchain that's saying you can earn 5-6% a year, no, that's not interesting because you can earn that in traditional finance, right, with lower risk. So approximately the returns that Phoenix provides are realistic as long as you can verify the source of revenues.
Perfect. So, you were talking about as one of the strategies, and 90% of the companies offering similar services or sort of investing oriented services in crypto who don't have their team up on their website, who it's very difficult to ascertain any information on them. So maybe you can just tell us a little bit about who's involved with the Phoenix app and, how it was built. As far as I can tell, it was incubated out of Hatchworks, where you're full time there. So
yeah, no, it's good. So Hatchworks is a technical advisor. We absolutely contributed manpower to it. The Phoenix company itself is not part of Hatchworks, but it's not in the Hatchworks group. It's a separate entity, separate shareholder structure, board structure. And in terms of the team, if you go to the team section, you will see the technical leads there. We have a testing team as well who does the user-assisted testing on top. And of course, we have a legal advisor that takes care of the licenses and all those things. We have a roadmap on the regulation side as well. So the whole team can be found on the Phoenix website. I'm, of course, there as well. If you also look at each member of the team, very important, you also see their career history. It's on LinkedIn. You'll be able to verify all those statements. We've been around in blockchain for 6 years now. So if you just Google us, you'll find out information about us. Yeah.
Yeah, no, it's just good to know. And as you're saying, when folks like yourself are showing up and doing podcasts, you're living and breathing. You've been fascinated with the space and building this. Really, it's a new opportunity for investors. One of the things, since we're talking about all about investing in crypto, this is sort of a news-related item that took the entire industry by storm and grabbed their attention. This is about the approvals in the US with the BTC ETFs. Can you, which have now since been approved, and it's had some impact on the market, and you can just provide your thoughts on, what you think that will do for the market and that sort of use case, and sort of where do you see, how will that impact the Phoenix app and what you're doing, if anything at all?
Yeah, no, that's a great question. So the approval of the ETFs is a very, very important. It's a seminal moment in crypto history and the blockchain industry because it legitimizes to a large extent an asset class so far that has been associated, as you know, with criminals, drugs, money laundering, racketeering, and all that stuff. cash has as well over time, but Bitcoin gets a negative rap. So the fact that BlackRock, Fidelity, and some of the biggest financial powerhouses in this world are now have backed it, and I wouldn't say twisted the SEC's arms to go ahead and approve it. You saw the SEC chairperson's statement as well. He basically wrote that although I have approved the ETFs, I don't actually condone Bitcoin yet myself. That just goes to show how much friction there was to get these out there, because the younger generation absolutely wants to get into the blockchain. Kids today are not going to be like, oh, can you please find me a retirement account earning me 4%? I really want to get into, real estate earning me 2% in Nevada or something like that. The world has changed. It's all about digital currencies. And that's why these big powerhouses know that in order to retain their competitive edge, they have to offer those products both to retail investors, but also to institutions and family offices and what have you. So they did that, and a lot of lobbying happened, and the world's most powerful banks were behind it. I know that Goldman Sachs and JP Morgan have applied to be APs, authorized placement agents. And what the ETF basically does is, so let's say Vanguard or let's say Fidelity or Goldman or whatever, what they launched an ETF. That's just the technical side of things. What that ETF allows to do is to raise funds by big money, and some of the marketing that goes behind this, some of the funds or the asset management fees they collect, that is spent on marketing and spreading the word around the world. And these organizations have huge networks to informing the public that it is actually okay. Yes, it's a high volatility asset class, but it is safe if you invest through it in the right way. And that's the ETF vehicle that allows the common person, they're not forced to go to some crypto exchange in China or something or wherever, give their KYC details, buy Bitcoin and hold it in some self-custody wallet and lose the keys to them. If you do it through an ETF, you have protections in place. So in answer to your question, it's very good because it basically increases the perceived safety of investing in that asset and also the sector as a whole. What it means for Phoenix is more flows. So the good news is, and I didn't mention this too much, but as a market maker in Phoenix, what you want is volumes. You want news. You're earning fees whether the markets are rising or falling, which is very unique. But what you want is basically more news. The more news, the more volumes. With the ETFs, volumes have gone through the roof. So going into the ETF, so I would say the months of July, August, September, October, November of last year, the volumes were picking up because we're coming out of the bear market. But generally speaking, the annual percentage yield you were earning on the highest pool was around 16, 17%. On some good days, maybe 20, 23%. Now it's moved up structurally to 30% on the weekends. That's another thing is the Phoenix app, you earn on the weekends as well because blockchain markets don't close on Fridays. They continue to make money on Saturdays and Sundays. Traders around the world can trade. They're not dependent on brokers. So when you see a tick up in these APYs in the system, you know that there's something happening. And now it's just the volumes have gone through the roof after the ETFs. And we will structurally continue to climb as well because we're just at the tipping point.
So getting back into the model and how the Phoenix app can work for investors, one of the things you mentioned earlier in the podcast is they have full access to their own invested capital. Is it possible, this is just a general question that popped into my head here, to take off risk off the table in part, so not the full amount, but have a program and say, I'd like to take off 5% of the gains every month as we go forward through this passive investing program. Is that sort of a feature that's, if it's not there today, is it something that you think will be introduced at Phoenix?
We listen to users, and if users tell us that we would love to have either an auto compounding, we receive that request a lot, auto compounding at a specific frequency. So as you said, every 5% every month, maybe reinvest it back, take the rest out, or take it out, send it back to my wallet, de-risk. We don't have these features coded into Phoenix code at the moment, but the auto compounding is something we definitely have to implement because so many users have requested it. So the answer is yes, it's not a feature that currently exists. What we do, however, urge users to do is to withdraw their fees every week. Just, it collects at the end of the week. It's collecting in real time, and then on Sunday, whenever you have 20 minutes, hit the withdraw, take your fees out, and pay yourself, right? And so the answer is yes. We want to code that in. We definitely want build that auto compounding feature in. One small thing to note is when you're moving capital to the liquidity pool, to the wider decentralized smart contract, there are gas fees. I won't get too much into it, but in blockchain, the whole blockchain is maintained. The integrity of the blockchain, whether it's the Bitcoin blockchain, whether it's the Ethereum blockchain, is maintained by miners around the world. They're called node runners, and you can run a server as well, which helps people process transactions, and you get paid in Ethereum, for example. Or if you're a Bitcoin miner, you get paid in Bitcoin. That's an entire industry by itself. Now, the system has to compensate you, a miner's fee, as a thank you for providing your server infrastructure to help process transactions. What that basically means is every time we are committing your capital on the curve, or when you're deinstalling the capital, when you're saying, okay, I'm done with the program, I want to take my money out, there's a gas fee to pay, right? So that gas fee is something Phoenix pays for you. We don't charge you that, just letting you know that. So that's something that we take from our management fees, we pay that. But it is worth noting that this whole process, gas fees can vary within the day. And sometimes they can skyrocket when the network is busy. And so this is why we advise users to do this not every single day, but to maybe do it every week or something like that. So even the compounding, you're going back to your 5%, we would say that it should happen at a frequency of maybe a week or 2 weeks or a month or something like that, rather than real-time compounding. Because the underlying system is strong, the integrity of these chains is very strong, they're very decentralized now, having been there for almost a decade, but they are still somewhat clunky when it comes to gas fees.
Yeah, absolutely. I've often read a story about those gas fees, and it's a lot more than coffee. It's a lot more than a price of coffee.
Yes.
So
you can end up paying. I mean, it's crazy if you're not careful. If you're trying to send $100 to somebody or receive, you can actually end up paying $100 to send $100 if you're not careful. But you can also end up paying just $1 or even less. You just have to time that right.
Absolutely. So, you bring up a good point about sort of the differentiation. How does the Phoenix app sort of compare and contrast with other staking platforms? Maybe, it's something to do on the product feature side, or it's how it's structured. Like this example, you're covering the gas fees, which I think can be quite significant. This is one less fee that can compound and grow and get you over time. So how are you different? How is the Phoenix app different from other staking platforms?
Yeah, that's a good point. So another thing is that when you go to a traditional staking app, and I won't get into the whole, we're doxed, people know who we are, and all those things that we don't have those red flags. I mean, that's a given that Phoenix operates in a much more above board way. But from a feature standpoint, yes, the fees thing is one thing that you mentioned. The second thing is when you're trying to stake and you go to another platform that claims to give you staking based revenues, what do you do then? You have to connect your MetaMask or your decentralized wallet to that specific network. Hope that you don't get hacked. I mean, that's a serious risk these days. Your own web browser can be compromised. And then after that, you have to monitor the pools, how much volume is going through certain pools. And that typically these other programs have hundreds of pools to choose from. So it's information overload. Funny enough, the APYs, what you can earn, and the risk is lower than Phoenix. So we actually have industry-leading APYs as well. That's after management fees. So that's after the fees that the system takes. So there's that. And then once you decide on a pool, you have to decide what ranges you as a liquidity provider want to provide liquidity in. If you want to provide liquidity across the entire spectrum, so for Ethereum prices of up to 10,000 all the way down to $100, you can do that, but you're not going to make much fees. If you go too concentrated, you're going to get stopped out, right? So you have to have fundamental analysis, knowledge. You have to understand where the sector is going. You have to also understand technical analysis. And given our backgrounds, we are all traders. We are all traders with backgrounds in high finance. We understand these things really well, and so that you don't have to. So if you go to these competing platforms, you'll get lost. That's what we're effectively saying. We also urge users to do that. If you're entering the space, look at some of the platforms. We can actually, if you ask us for tips, I'll be very happy to tell your users which are competing platforms to go and test those out. And you'll see it's a complete nightmare. Once you're in there, you don't know what's actually going on. With Phoenix, you're sending money to the Phoenix app. The app money spent is immediately allocated on the liquidity curve, and you start earning, and you can withdraw your capital. So we really dumb things down.
So it's immediate. Once the capital is there and into the Phoenix app, um, the program will algorithmically participate that portion as a market maker. And one thing I saw on the website was around the ability to reduce risk through hedging or hedging capital risk. Can you just explain how that would work for an investor in a simple way? Considering that, let's say they might be a retail investor, they don't want to be overwhelmed with all the pools, but they want to make sure that the team is there, they have confidence in the technology, they understand the fee structure, how they can get their money in and out. What about the hedging or other ways that they can reduce their risk through the Phoenix app?
Okay, so the risk that you have as a user in Phoenix is that the prices of Bitcoin and Ethereum tank. Let's say they fall by 50, 60%, okay, and the market enters a bear. And although that risk is reducing now after ETFs, because the products are becoming more and more institutionalized, and so you have checks and balances in place to stop those type of gyrations. But let's say that happens. You want to make sure that you have the least exposure to those currencies when that drop happens. So the simplest way to do it is to go into buffer, which is the lowest risk pool. I gave you an example. If Bitcoin fell by 20%, your capital would drop by 1 to 2%. So it's already very low risk. If you want to have completely like no downside risk at all, that's trickier. That's a bit more trickier, and it's not something we would advise to a retail investor because that involves shorting. Specifically, that involves taking out a put option contract and basically paying the premiums to the option underwriter, but then your downside risk as a liquidity provider is completely hedged. And also, if the price shoots up, you don't lose out on that. If you did a naked short on Ethereum Bitcoin, the problem with you then is, okay, if Ethereum Bitcoin fall, great, you make money on that short, but you'll take a big hit if they rise, right? There's no way to hedge out a rise. And so, although I don't want to get into put option and option underwriting here, for the more institutional, sophisticated investors, those instruments do exist. But for the retail investor, it's not something we would advise. What we would basically say is go into buffer, which is a very, very low risk pool, an extremely low risk pool. Although you don't earn much money, 7 to 10%, maybe 11% a year, your downside is extremely limited.
Yeah, okay, great. Thanks for illuminating on that. What about leverage? Often in the crypto investing space, you see advertisements, 200x leverage, 500%, and all of these things could look like opportunities, but what are your thoughts? And do you offer leverage at the Phoenix app?
Very good question. No, we hate leverage. So we're low risk. We don't like leverage. If you are an accredited investor, you understand leverage and you have access to credit facilities and you want to go in big on Phoenix, we can get our legal team in touch with yours and we can have a discussion about how such a pool would look for you so that your capital is safe and generates and pays off your interest on the leverage. But no way would we ever recommend leverage or for anyone to take out a loan to participate in Phoenix. Although the Phoenix is a safely engineered product, the downsides are pretty well protected. Loans and crypto don't mesh. I would never recommend that. Now, if I personally, because I'm an accredited investor, I'm a quote unquote, I fall under the category of sophisticated investor. I do like where Bitcoin is headed, and I wish I had more capital. And I have, our company has thought about accessing leverage to go long Bitcoin, like Michael Saylor did, right? And his bet has paid off fantastically for MicroStrategy. So, but for Phoenix, no, the answer is no. In general, leverage is bad in the space because, we discussed that quotient, 85%, 90% of traders lose money. Those that are using leverage, 98% of traders blow their accounts. So I would not advise taking out leverage. For Phoenix, you don't need leverage. You really don't need leverage. You don't.
Okay, great
And on
answer.
that point, I'd like to say that the good news is we have reduced the minimums because we want to also bring Phoenix to emerging markets. It used to be $1,000 to get into these pools. Now it's 100.
Minimum $100 investment for.
Yes,
Okay.
exactly.
Got it. Okay, well, that's good to know. Let's switch gears a little bit about maybe the industry level on regulation. And the DeFi space has been a hot sector and an area of great interest for a lot of investors, as well as all the builders and innovators. It's really about, well, there's many facets to it, but, I see that direct-to-consumer investments and, disintermediating some of the brokers that are involved in the process.
Yes.
But from a regulatory perspective, what are your thoughts? As governments, securities regulators try to wrap their head around striking the balance, I'll use that word, for on the innovation side and ensure that there's not a flow out of capital from their country. They're still providing investors in their countries these great opportunities. But we're living in a global world where investors can come from all walks of life all around the globe. What do you envision? Well, maybe you can talk about the current state of regulation for DeFi today, and where do
Yeah.
you see it maybe moving in the near future?
It's a good question. It's a fantastic question. The thing is, in DeFi is a niche inside crypto. It's a specific niche, and DeFi, as you rightly said, is this disintermediating the powers that be effectively. In theory, in a world that was run purely on DeFi, you would not need your broker. You would not need JP Morgan Chase to buy shares in Tesla. That's the truth. So it challenges the very essence of what the big banks are built on, their trading revenues. So you're basically taking them on. So to regulate DeFi, in my opinion, is going to be a very, very, very big hurdle. If there's going to be any sort of DeFi, it'll be happening between banks, if you ask me, because they want to protect what's theirs. And so I think ultimately, like it or hate it, regulators are very much influenced by big bankers and lobbies, as you see in the US, right? Washington, D.C. is pretty much very well financed by banks and all this thing. You saw how much pressure BlackRock and these big guns put on the SEC to approve the ETF. So it's very unlikely that these regulatory agencies, and in answer to the question today, they haven't sided with Joe Public over the banks. So, and that's how I think it will continue. I don't think, I'm not actually a DeFi enthusiast myself. I know the industry pretty well. I can tell you, for the reasons I mentioned now, but also the quality of DeFi projects are so bad that it gives regulators a lot of ammunition. Basically say, oh, well, look at Luna, right? Look at this company, look at this. We can't, the only way we can regulate this is try and shut it down because it's just garbage. So there are good concepts in DeFi. Phoenix is an example of DeFi. Uniswap is an example of DeFi where you can become a liquidity provider. You don't have to go to or trade against a broker. You can make money in a new way. But these kind of dark projects, black box projects, where like Luna, where you don't know what you're earning from where and stuff, they end up collapsing. It's difficult to regulate those. Traditional regulation, just to end on a more positive note when it comes to is moving forward. So there's regulatory arbitrage. It's a great point that you brought up because what's happening is if you're in the US and this ETF approval didn't go through, capital would flow out. It would go out to other jurisdictions that are more accommodative for blockchain regulation, like Singapore, like Switzerland, like even the UK. Now, after the ETF approval, the Americans have kind of gotten the upper hand again. Almost 50, 60% of capital flows for blockchain are still in the US. If they lose that to other countries, that's a massive competitive disadvantage. So right now, regulation is moving forward. Everyone's looking forward to see what America is going to do next. And slowly you start to see the right moves also in Europe. For example, Germany is quite pro-Bitcoin, which may surprise you. UK claims to want to be the market leader, but they've been quite slow in approving ETFs and all these things. But Switzerland has been ahead of the curve, so it's moving forward. Hong Kong is moving forward as well. China is a bit more draconian on that front. So it's a bit of a, I would say, it's a pockmarked progress.
Yeah, it seems we're hitting a tipping point with more institutional adoption and regulators and governments worldwide, whether they are on this side of the fence or that side of the fence, they're recognizing the value of the technologies. That's a good segue into more of the innovation type question. I know on a lot of our podcasts, a popular question is around the impact of artificial intelligence and what that type of intelligence combined with, say, a retail investor or any type investor, Do you see AI having a big impact into sort of your business and DeFi and in particular from an investing perspective?
I would say AI is very exciting from a trader's perspective because we all, in an ideal world, we don't want to put the effort to learn to trade the markets. We'd ideally like to have a little robot that can trade the markets more efficiently and make money for us, ideally on a monthly basis for life, right? That's what we want. But it's very difficult to get that right. And I think in answer to your question, now with ChatGPT, we need to see the capabilities of how well AI can ingest the myriad of data that it needs to do, both qualitative and quantitative data that the internet spews out, in order to make qualified investment decisions that can actually make a sustainable return. We don't know right now how successful it is. I can tell you there's no retail AI robot that makes money. Even after ChatGPT, it's been out for almost 1 year and a half. There is no retail robot that makes money that's truly sentient. There might be neuro, what you say, NLP models that are repurposed by major investment banks and hedge funds, quant funds that can make these guys money. But we retail people, we don't have access to that technology. So I think, long story short, in order for brokers to exist, traders need to lose money, unfortunately. That is how the markets are kind of structured, wired right now. With Phoenix, it's different because there you are the market, you are the broker, effectively. You're selling Bitcoin and Ethereum passively. But with your traditional model, I think AI challenges that as well. And I don't think the big banks would want to see you or me get our hands on that. But that's just my view.
Yeah, it's such an exciting time around the world. I mean, AI is really hungry for data, and that is processing and ingesting that data is allowing the personalization of our lives. Who wouldn't want an investing robot with the
Yeah.
guards and rails to protect us? But certainly envision these types of market making programs and investment models that continue to evolve through innovation in the crypto space to continue and forward. So I guess, as we sort of move towards the end of the podcast, we'd love to hear your thoughts and, what do you think the whole crypto investing space, the DeFi space, the model and the area that you're focused on with the Phoenix app will look like in 5 years, and coupled with that, what sort of, are we missing anything in the discussion? We'd love to give you an opportunity to share a story or something that you feel would appeal to investors or anyone that might have concerns. It's really, the ball's in your court to help wrap this up.
No, sure. Thanks, Craig. So I would say, in answer to your question, if you take a 5-year view on where the space is headed, after the ETFs have been approved, this, as I said, was a seminal moment. It will allow more information, more correct information, and safeguards for new investors to be put into place so they can access blockchain technology safely and make money. More importantly, make money. And AI right now is broadly used in blockchain as a buzzword and by projects to lure you in, basically. AI-based staking and all that. It's all nonsense. It's another red flag for me. 5 years from now, I think DeFi would have progressed. I think would have been more regulated. I think the returns would drop as well as more realness enters in, which is important. And I think it'll be like any other asset class eventually. All the various cryptos and stuff. What I would do right now, would urge all your users that have not done so, is whether they like to join Phoenix or not, that's totally their prerogative. We're very happy to receive them. But more importantly, we're sitting at a very important time in the history of investing. You look back 20 years ago, you look at what Microsoft did, 40 years ago, 30, 40 years ago, Apple, what those stocks were trading at back in the late 70s, the late 80s, as you know. And you look at that amazing chart and you're like, well, had I invested back then, right? Have we not all done that? And what I would ask people to do is to spend some time, like we did in 2016, which was life-changingly important for us as a project, to enter the blockchain with the smart contract, to get rid of brokers. And that was a very big project for us that kind of gave us the wings to create future projects. I would ask all of your users who have not done that already to really get clued up on what is happening with Bitcoin and blockchain. specifically what the ETFs mean for the access by the public to this technology. In short, I mean, again, I don't like to give investment advice, but you see what's happening to your cash in the bank, inflation, risks of bank failures, all these things. And then you see, of course, a potential competing mechanism for cash, one that does not deflate, one that is truly that you can own as yours, cannot be confiscated by governments. It's important to see what these ETFs mean for the space and also prices for Bitcoin price, Ethereum over the next 5 to 10 years when planning your investments, because these opportunities may not come back. So that's what I would say. And once you look at Bitcoin, Ethereum, you learn about those. Only then I would say is you can kind of graduate to the other more kind of riskier niches in blockchain, like DeFi, like NFTs and all of that.
Well, you heard it, folks. The not advice, not investment advice, but from a seasoned high finance investor who's been involved with incubating lots of projects and dedicated to the Phoenix app. I think it's exciting times, especially with the approval of ETFs, potentially an Ethereum ETFs. All these new technologies in the market today, and they're only going to continue as Kay was talking about on the ground floor. If you get involved, get educated, ask questions, but by all means, you should get in touch with Kay. On that one, we would just say, how do users sign up, and maybe how can they find, if anyone has any follow-up questions with you, Kay, how do they get involved? How do they get in touch with you?
Absolutely. So obviously they can contact you, Craig, but if they want to come directly, just go to www.phoenixapp.io. And there's a range of contact buttons there, email, also our Telegram community where I'm there as well. Our users you can chat to our users as well, ask them about their experiences. And you can also sign up to the app. We have a Mac approved downloadable app, also PC approved downloadable app. But if you don't like downloading stuff, you can just click on Launch App on our website and you can sign up there as well. What I would advise you is actually do that and get to know us, get to know the project, monitor the performance for a few months, and don't invest now. Just monitor, learn what Phoenix is, because automated market making is so unique. It's a great source of revenue, but get educated first on it. And when you're ready to take the dive, then you can always do that in the future.
That's good, good information. And before we really wrap up the podcast, we can't finish it without our rapid fire questions. It's my favorite part of the show. We're just expecting quick responses, and just everyone, it feels it keeps it personal and interesting. So we're gonna close this out with the rapid fire questions. You ready for that?
Yeah, go. Let's go for it.
Okay, so in a word, how would you describe the future of crypto?
Booming.
What was that?
Booming.
Booming. That's right. That's fair enough. Moving on. What is the number one risk investors should be aware of in DeFi?
I would say non-doxed teams. So teams that don't want to show their faces. That's a number one risk.
Anyone? Yeah, not no transparency, basically.
No transparency.
Hiding under the covers. Okay, good answer. Next question. What's your personal mantra when it comes to investing in crypto?
My personal mantra is don't invest. The first thing to do is you're not going to miss out. You're not going to miss out. The space is headed up in asset prices over time. Do not worry about that. Take your time to research the project. And you can make a lot of money, but you can lose a lot of money as well. So I would say just take that time, that 1 week or so of really getting to a project. And very importantly, when you're ready, look at the world if you lost that money. How would that affect you personally? How would that affect your dependents, your codependents, your future, your kids, everything? If you believe that that will really put you in a bad place, don't touch this investment. Always only invest money that you can afford to truly lose. And I know people say that, but it's only when they lose the money do they really feel that pinch. So be very, very careful.
Yeah, that's great advice. Don't bet the bank, and don't take a second mortgage out.
Yeah, no, definitely don't take out second mortgages.
Next question. Name a recent favorite book or movie that you would recommend to our listeners.
Favorite book or movie? I've been watching Entourage. I don't know if you guys know that. Watching the reruns. It's so entertaining. It's a great show. Sure, a lot of you already know it. My wife keeps up with the more latest Netflix movies and things. I just don't get time, but that's what came to mind right now. I've been watching that, so that's great. You would love that.
That's why you need the robot investor, so we can all have more time
Yeah, exactly.
to watch
Exactly.
Entourage. I don't know it, but I got Netflix. I'll have to search it
Oh,
up.
you love it. You love it. It's really addictive. It's good.
Perfect. So last question before we wrap up officially is, what's your favorite go-to financial tool or app?
Oh, TradingView by far. I love TradingView. I'm sure you guys all know it. It's just fantastic. It's so well designed. I met the founder a few years ago just on Skype, very accessible, and it was nobody. No one was using it. And today they're a global company. They pretty much, I think they have 80% market share, retail. Really great app for free as well. Of course, there's a premium version as well, but you can get so much data about charts, analysis, trading strategies, news. Great. It's like a Bloomberg terminal for the retail.
Yeah, TradingView is good. It's not that expensive. Maybe it's a couple
Yeah,
$100 for the pro version, and all sorts of bells
exactly.
and whistles and integrations as well. So with
Yeah.
that, folks, you heard it. We really want to just thank Kay Khemani, who has shared his knowledge and expertise. He's involved with an incredibly exciting project at the Phoenix app, and his advice or non-advice to investors has been wonderful. Just take it slow, get educated, watch and learn. And if you have questions, connect with folks that are transparent and, willing to show their face and be along for this incredible journey. So once again, Kay, want to thank you. You're welcome back anytime. It's been awesome having you here.
Thank you for
And
having me. Appreciate it.
yeah, well, come back in a couple of years. We'd love to hear
Yeah.
where Phoenix app is, and if anything interesting comes out of Hatchworks, get in touch for us for sure. Other than that, this is the conclusion of episode 61. And I'd just like to say, if you're new to Fintech Fridays, please check out some of our incredible past episodes. We think you'll be surprised with what you'll find. We look forward to seeing you next Friday for another episode of Fintech Fridays. Have a good weekend, everyone. Thank you.
Thank you.
You've been listening to Fintech Fridays, brought to you by NCFA and Partners. Tune in weekly for the latest Fintech Friday podcast by subscribing to this channel. The National Crowdfunding and Fintech Association of Canada is a nonprofit actively engaged with social and investment fintech sectors around the globe and provides education, research, industry stewardship, services, and networking opportunities to thousands of members and subscribers. For more information, please visit ncfacanada.org.